Everyone wants their money to work harder, but almost nobody wants to do the actual work. You want to buy your shares, close the app, and go back to living your life while your wealth builds in the background. And honestly, that's exactly how it should be. Active trading is a part-time job that most people fail at. Passive investing is a wealth machine. Today, I'm going to break down the top 3 set-and-forget exchange-traded funds, or ETFs, for Australian investors in 2026. These are the core funds that let you buy a massive slice of the global economy with a single click, allowing you to build serious long-term wealth without checking stock charts on your lunch break. Before we name the specific funds, we need a reality check on where everyday Australians actually stand with their investments. According to recent ASX investor study data, the average Australian share portfolio sits at around $130,000. Sounds impressive, right? But here's the catch. That's the mean, not the median. A handful of massive self-managed super funds holding millions of dollars in banking and mining shares drag that average number way up. The median portfolio for everyday retail investors is actually closer to $20,000. If you're looking at your brokerage app right now with 5 or 10 grand in it and feeling like you're hopelessly behind, you're not alone. You're right in the middle of the pack, and that's completely fine. Most people in their 30s and 40s are just getting started outside of their superannuation. The fact that you're in the market at all is the most important step. To build a true set-and-forget portfolio, you need funds that do the heavy lifting for you. Coming in at number 3 is the foundation of local wealth, the BetaShares Australia 200 ETF, known by its ticker code A200. This fund buys you the 200 largest companies listed on the Australian Stock Exchange. We're talking about the big 4 banks, BHP, Woolworths, and CSL. The Australian market is globally famous for paying out large dividends attached to franking credits, which are essentially tax discounts from the government. What makes A200 the ultimate set-and-forget option for local shares is its incredibly low management fee, which currently sits at just 0.04%. To put that in human terms, if you invest $10,000 into A200, the management fee is exactly $4 a year. That's less than the cost of a single takeaway coffee to have a professional fund manage your slice of the entire Australian economy. But you can't just invest in Australia. Our local market only makes up about 2% of the global economy, and it's heavily concentrated in financial services and mining companies. If you want exposure to global technology, healthcare, and massive consumer brands, you have to look overseas. That brings us to number 2, the Vanguard MSCI Index International Shares ETF, or VGS. This is your global growth engine. VGS buys you shares in roughly 1,500 companies across 23 developed countries, specifically excluding Australia. It gives you instant ownership in companies like Apple, Microsoft, and the major global healthcare giants. According to Vanguard's latest 2026 cash flow reports, Australians poured hundreds of millions of dollars into VGS in just the first quarter of this year alone. It's the perfect counterbalance to an Australian-heavy portfolio because it provides the rapid capital growth that our local dividend-heavy market often lacks. Now, you might be thinking about leaving your money in cash instead. After all, the Reserve Bank of Australia has kept the cash rate high through the start of 2026, and high-interest savings accounts look tempting. But doing nothing with your investment capital is the most expensive decision you can make. While savings accounts are paying around 4.5%, inflation and tax are quietly eating away at the real value of those returns. Over a 10-year horizon, leaving $100,000 in cash rather than investing it in a broad global index fund means you're essentially bleeding massive amounts of potential compounding growth. Time is doing most of the work in an ETF portfolio, and compound interest starts pulling serious weight when you give it global exposure. But what if buying 2 separate funds, balancing them, and logging in to check on them still feels like too much work? What if you truly just want one single ticker code that does absolutely everything for you? That brings us to the ultimate set-and-forget option. Coming in at number 1 is the Vanguard Diversified High Growth Index ETF, or VDHG. If a 200 is your local foundation and VGS is your global engine, VDHG is the entire car, pre-assembled and ready to drive. This is an all-in-one portfolio, wrapped into a single ETF. When you buy 1 unit of VDHG, Vanguard takes your money and automatically splits it across several different underlying funds. They put roughly 36% into Australian shares, 54% into international shares, and the remaining 10% into defensive assets like global bonds to smooth out the ride. The beauty of VDHG is the automated rebalancing. If global tech stocks have a massive run and suddenly take up too much of your portfolio, you don't have to log in and sell anything. Vanguard does the math and rebalances the fund for you in the background. According to recent market data, the sheer volume of money flowing into Vanguard's diversified products proves that everyday Australians are tired of picking individual stocks. They just want a vehicle that tracks human progress over decades. If you have a long time horizon and you genuinely want to delete your brokerage app and only check it once a year, VDHG is the closest thing to financial autopilot that currently exists on the Australian market. But here's the part most people miss completely. It's the hidden insight that traps thousands of beginner investors every single year. I call it the overlap illusion. When people discover ETFs, they get excited. They buy a chunk of A200 because they want Australian dividends. Then they buy some VGS for global growth. Then they hear about VDHG and they buy that too, thinking they're diversifying their portfolio even further. But they aren't. Because VDHG already contains Australian shares and global shares, buying all three means you're just overlapping your investments and paying multiple management fees to hold the exact same underlying companies. If you hold VDHG, you already own the big Australian banks and the major global tech stocks. You don't need to buy the separate building blocks if you already bought the finished house. Choosing between a custom mix of two funds or an all-in-one fund is a structural choice, not a collection to collect them all. The reality of building wealth in 2026 is that it should feel slightly boring. We're conditioned by social media to think that investing requires high-stress decisions, timing the market, and watching geopolitical news like a hawk. But successful long-term investing is the exact opposite. Once your structure is in place and your automated transfers are set up, your behavior matters far more than what the stock market does on any given Tuesday. Being a wealthy investor isn't a destination. It's a moving target. The goal isn't to perfectly predict which sector will boom next year. The goal is to capture the broad upward trajectory of the global economy while you